Exiting and profiting from direct investments. At its core, investing is somewhat simple. Buy low, sell high. Of course, this is much easier said than done, especially with direct investments where there is no public market to buy and sell shares of companies. But the key to making money is to actually sell your stock or exit the investment. In this video, we will discuss exiting and profiting from direct investments. As one would expect, the exit is usually the final step in the investment process. However, it probably should be the first thing you think about when evaluating potential investments and should be an integral part of your negotiations and ongoing management of the company. The 5 most common exits for investors are: 1. The initial public offering (IPO). 2. Merger or acquisition. 3. Management buyout. 4. Secondary buyout, when other investors buy out your stake in the company. And 5. Bankruptcy. Unfortunately, this list is not in order of frequency. If it were, bankruptcy would be higher up on the list. In fact, here is a list in order of frequency. 1. Merger or acquisition, 54%. 2. Bankruptcy, 24%. 3. Management buyout, 10%. 4. Secondary buyout, 5%. 5. Other, at 7%. And 6 would be initial public offering (IPO) at less than 1%. More than half the exits come from selling to or merging with another company. About half the other exits are bankruptcies. The remainders are a mix of buyouts from other management or other investors, or a host of other possible exits. IPOs are very rare, although they receive a lot of media attention. Keep in mind, the exit type does not necessarily correlate with exit returns. Many of the exits are losses to the investor, but are exits nonetheless. When can you sell? In some industries, your timing may be based on financial milestones. The large players in one industry may only be interested once a company hits $10 million or $20 million in revenues. In another industry, you need not apply until you have a minimum number of customers. In another, the requirement to sit at the table may be a presence in a minimum of number of retail outlets. In other industries, the only requirement is that the demonstration of an exciting new technology. In these situations, big companies would prefer to buy instead of build it themselves. In general, the time to sell comes once you prove the business model. This means you, and potential buyers, know the exact profitability for each new customer, which is the gross margin per customer times the expected customer lifetime, minus the cost of acquisition per customer. Then it is almost a question of, if we feed this much money into this formula, how much money can we get out? It is also important to try to sell on the way up, not on the way down. Sell when the company is still growing and increasing profits. This may seem counterintuitive because you naturally would want to sell when the stock price is at its highest. But it is hard to predict the peak and very costly if your timing is too late. With management buyouts, timing may depend on other factors. Perhaps the most important is when the management team has the financial ability to make the deal. This can be hastened with the debt they take on, which is called a leverage buyout, or with the assistance of outside private equity. Sometimes the opportunity is created, or forced, when the founder wants to sell out or retire. The middle management team, or even all the employees, may want to take over and continue operating as normally as possible. How much can you make? In the most extensive research study of angel investments and returns to date, by Robert Wilbank of Willamette University and Warren Boker of the University of Washington, founded by the Ewing Marion Kauffman Foundation and Angel Capital Education Foundation, several relevant statistics were discovered. 52% of all exits were at losses for the investors. Less than half of the exits were at gains. 7% of the exits achieve returns of more than 10 times the money invested, accounting for 75% of the total investment dollar returns. In other words, most of the returns came only from 7% of the exits. When the researchers looked at returns and time, they found that, on average, better returns took longer than smaller returns. Correlation does not mean causation, but this surely makes sense. It makes sense that highly valuable companies may take time to grow. It also makes sense that investors would hold on to deals continuing to grow and try to extract as much value out of them as possible, even if it means waiting another year or two. So patience can pay off. The data here also shows the most profitable exits happen within 3 years and at somewhat modest returns of 1 to 5 times of the initial investment. Other research also shows the largest number of exit transactions today are for less than $20 million, and often within 3 years of startup. So statistically, you should expect your companies to be acquired for less than $20 million within 3 years. This may generate a return for you of 200 to 500%. Of course, this is a generalization based on historical data. It does make empirical sense as well, but your actual results may vary. How can you increase your profit from the sale? There are a number of ways to increase the value of the company and price tag to the buyer. 1. Understand what drives value for buyers. As we mentioned earlier, help push the company's profitability, market expansion, technological development, etc. 2. Work with financial experts to make changes to the balance sheet or corporate structure to maximize your returns, independent of the company's actual operations. This could mean using debt or even sub-debt or implementing new tax strategies. 3. Focus on more strategic value. It's like selling a house. If it is in a good school district, then it will be valuable to buyers with families. If it has a big, modern kitchen, that will be valuable to a certain type. The key is not to make up the value, but position the existing assets or characteristics of the company to be more attractive to the right buyers. If you have proven the business model, strategic buyers are companies that can change the formula in their favor. This means they feel they can get more of a profit per customer because they have complementary products or services on top of yours, or they can lower the cost of acquisition because they have customers who would be interested in your product or service, or existing channels to reach more customers cheaper. 4. Try to find multiple, competing interested buyers. This is one of the best ways to maximize the price you receive. If the company in which you invested is truly valuable, especially strategically valuable, it should be attractive to multiple acquirers that compete with each other for their core business. For example, Coca-Cola may not want to only acquire your company for what it is, but may also want to acquire it to keep its competitors like Pepsi, Nestle, and Dr. Pepper Snapple from acquiring it. Pepsi, Nestle, and others may feel the same way. This situation is ideal for increasing the profits that you can realize from the investment. Having multiple bidders also increases the likelihood of a sale. 1 or 2 companies may back out, but it only takes 1 to close a deal. And 5. Negotiate. Even after all of the work you put into these 4 strategies, the final price can vary widely based on your team's actual skill at selling and negotiating. This is one of the skills that M&A advisors or brokers can bring to the team. Also keep in mind that after all is said and done, the actual deal structure can depend on a number of issues, some of which may be outside your control or expertise. For example, tax considerations, structure and size of buyer, complexity of your company, or the potential integration with the acquiring company. To review and summarize, the basic process for completing an exit is to identify potential exits before you invest and to make sure the management team, the investors, and the investment documents are all aligned for the most likely exit. Keep the house in order from the get-go and prepare early for due diligence that will come. Make sure all the corporate documents are in order, the financial records are audited, or at least reviewed by a CPA, and all legal agreements are adequate. It is much faster, easier, and cost-effective to have these kept up to date than it is to fix them at the last minute. Hire a successful and skilled M&A advisor. It will cost more, but good advisors or business brokers can help you get higher bids that more than cover their costs. By the way, in most cases, it takes between 6 and 18 months from the time you engage with a broker to the time you receive your proceeds from the sale. So, plan accordingly and be prepared to bring on the advisor early enough. Generate interest from multiple bidders. Selling a company is much like selling anything. You need to start with a relatively large number of prospects, manage the sale process, whittle down the target list, and then focus on a few very interested buyers. Negotiate and close. With or without the help of an M&A advisor, One of the key roles you, as an investor, can play is in the negotiations. You can play the bad guy, so the CEO can be the good guy. This is especially important if the CEO will stay with the company after it is acquired by the new company. We hope this brief video helps you better understand the all-important process for exiting your investments and maximizing your returns.